What's going on, everybody? Liam O'Reilly, Vermont economic realtor with Jerry Riley Real Estate. We're talking about CPI today, what that means for the housing market, what that means for mortgage rates, what the Federal Reserve is going to do with these new CPI numbers, how they're going to react. So, headline CPI, as I'm sure you saw, was at 4.9%. But really the big story, I think, the big number, in my opinion, is the month-over-month data, the unadjusted month over month from March to April, CPI number was 0.5% month over month, which translates to about 6% annually, which is way too high. It's way higher than the 2% Federal Reserve goal, and it's way higher than what would be healthy for a sustainable currency. So let's quickly look at the data, and then we'll talk about how it's going to affect the Federal Reserve and how it's going to affect the housing market, what you should do as a buyer or a seller with this data and with the uncertainty in the market right now. So here we go. Unadjusted percentage change, April 2022 to April 2023, this number right here, 4.9. And then from March 2023 to April 2023, this is what I think is the big red flag, 0.5%, right? With the unadjusted percentage change, the year over year number, that is more of a it's a broader number, right? It's the past 12 months. There's been a lot of rate hikes within the past 12 months. So, even though it's trending down from where it was last month, I believe the March CPI was 5%. So there's a little bit of a trend down year over year, but what I think is most important is what's going on right now, and that's where the month-over-month data is. From March to April, it's up 0.5%. Now, a big portion of CPI that we've talked about on this channel before is shelter, and they don't use, the majority of the shelter is the owner's equivalence rent. Rent of primary residence, 7%. Owner's equivalence rent, 25%. And this is of the total CPI number. So if we look at the total rent, the owner's equivalents, and the rent of primary residence, we have 8.1% year over year and 0.4% month over month. So obviously the year over year is really high. There's a little bit of a lag in that, and Jerome Powell mentions this in his press conferences, that because leases roll over on an annual basis, that it might take some time before these numbers even out on a year-over-year basis, but still 0.4% on a month-over-month basis, it's pretty consistent. I mean, it's a little bit lower than the unadjusted change, but it's still pretty consistent with higher than usual CPI, right? You're going to be right under 5% shelter inflation. And I think a big reason for that inflation is the higher interest rates. Now, we can go into an argument of, is this really a good indicator of shelter inflation? Are the owner's equivalence rents, which is essentially they ask homeowners, what could you rent your primary residence out for? Is that necessarily a good indication of what the market's doing? I don't really think so, but I guess that's an argument for another day. I think the real important point is that inflation is going up by the way that the Federal Reserve is measuring it. So just based on these numbers and based on what the month over month data specifically is doing, the Federal Reserve, they're hiking of interest rates. It's not getting the job done. It's not where they want it to be. They'll want to see that number come down, want to see a flatter number around 2% for a reasonable amount of time before they're going to feel comfortable that they have inflation under control. Now, at the same time, we have these banks that are in trouble that we've talked about in other videos in the past. And something to note about the banks is that we haven't even really seen a collapse in the commercial real estate market yet. And that's pretty much expected with these higher rates. It's hurt the commercial real estate market. A lot of these small regional banks have a lot of their balance sheet is commercial real estate, is loans against commercial real estate. So as these assets are being hurt, especially in office spaces, but also with apartment buildings and just general commercial real estate that isn't going to trade at the same price because interest rates are higher now. These assets are in trouble, and that could further spark more banking trouble. So in my opinion, the Federal Reserve is really stuck between a rock and a hard place, where they can either cut rates and help out the banking sector, try to keep the jobs market strong, try to keep the economy flowing. But at the same time, that's going to hurt inflation. I think. I mean, it's just going to be more money into the system, more loans being generated, and is not going to be great for inflation. Albeit, how much of inflation is on the demand side versus how much is on the supply side, where the Federal Reserve is working to hurt demand by keeping interest rates high. Whereas if they lower interest rates, that should stimulate growth in the economy, encourage people to borrow more, encourage business owners and entrepreneurs to borrow more to bring more supply into the market, which obviously the Federal Reserve doesn't feel this way, but it seems like that would be a positive thing for the supply side, which could help the economy. But regardless, the Federal Reserve, they want to raise rates to try to bring inflation down. So they have that option with potentially, more banking turmoil as a result of that, or they can lower rates and let inflation run wild, which none of those options are really a good place to be in. Now, as far as the housing market and what's going on in the housing market with these rates, if we just take a quick look over at Redfin's stats just to see what's going on with the median home price. I'm going to do another video on the Redfin market update in the future here, but median sales price, if you see this trend of the orange line, median sales price is still trending upwards. Obviously, we're down year over year, down 2.7% year over year, but that gap is not widening. We're still seeing an increase in home prices as listings are low in the overall economy. And I just wanted to show some quick data about what's going on here in the Vermont market, specifically around Burlington. If we take a look at these homes, now these are all closings that happened this week, and I did cherry pick these. So this is not every listing, but it shows what can happen when you price a property appropriately and generate the amount of interest that's out there. Look at this: 4 South Cove Road, Burlington, listed for $1 million, sold for $1.2 million over there in the middle of your screen. If we look here, Stevensville Road. Now, I think this property was underpriced by a little bit, but still listed for $500,000, sold $707,000. Some of these I think are pretty crazy. Like this one on Dodds Court, I'm blown away by this number. Listed for $419, sold for $552. 1,300 square feet, 3 beds, 1 bath. I'm going through the pictures right now to give you guys a feel for the inside. It's not a completely renovated property, and I think $419 is a pretty reasonable list price for a property of this size in the New North End of Burlington. Still sold for over $100,000 more than what they were asking for. Birch Street in South Burlington, listed for $399, sold for $480. 2 beds, 1.5 baths. This is pretty nice. It's in pretty good shape, but still, it's not a huge home. And then we have this one, 281 Heinsberg Road in South Burlington. This one actually had over 20 offers on it, I believe. Sold for a little over $100,000 over asking. So the housing market is very hot and still very strong, especially around here in Vermont. So what do you do as a home buyer or a home seller? Now, I think as a home seller, I think if you're thinking about selling within the next year or so, or even 2 years, I think now is probably the best time to list your home, at least around here in the Burlington area, because we know what the market's doing right now. We know how competitive it is. At the same time, CPI is high and mortgage rates are high, right? Mortgage rates, if we go over to NEFQ real quick. I don't have it pulled up, but let me just pull up NEFQ rates and show you guys here. So 6.25% for the best 30-year fixed rate you can get roughly. So rates have been floating around there for a little while now, are probably a little higher or on the high end of the spectrum that we've seen over the past few months. But if CPI is high and mortgage rates are high, that means it's harder for people to purchase properties, right? It's harder for people to qualify for properties. And if CPI remains high, consumers are spending more to live, just generally speaking. That means they're going to be spending more of their savings, or at least are going to have a harder time saving money. And so if this continues, if we can't get CPI under control and mortgage rates stay relatively high or go higher, that is going to put downward pressure on demand and be worse for you as a seller. So again, we don't know what the Federal Reserve is going to do. We don't know what the future is going to hold here. But I think there's a good chance that either, if the Federal Reserve cuts rates, it could be because we do experience a massive, banking issue and people lose their homes, which is not going to be good for demand. If they don't cut rates and CPI still remains high, that's not good for demand because affordability is low and CPI is eating into their savings. Now, it's not going to hurt the highest end buyers who are purchasing a lot of the homes right now. But what it will do is it'll cut down on the competition and cut down on the bidding wars that are out there. So I think right now, if you're a seller, it's probably the best time to get into the market with the uncertainty that we're looking at ahead. Now, if you are a home buyer, I think your best option is to, again, look for the opportunities out there. Try to find homes that people have ignored or people aren't attacking. That is going to be your best course of action. I would still recommend getting into the market right now, depending on your situation. If I guess if you're a first-time home buyer and you're renting, I think it's a no-brainer to get into the market right now if you're considering that in the next few years. Again, because we don't know what's coming up. Either mortgage rates drop, more competition rushes in, and the economy stays stable. That's not good for you as a home buyer. You want to be in the market for that run-up. At the same time, if the economy collapses or something happens and this competition deteriorates, it's not just going to go away because people lose the desire to purchase properties. It's going to go away because people lose their ability to. So you have to ask yourself, would you lose your ability to? Would you, if CPI remains high, do you have enough savings to weather that storm? Or, if you lose your job or lending really tightens and loans aren't as accessible as they are, will you be able to purchase a property? So I just think there's a lot of uncertainty out there. We really don't know what's going to happen over the next few months here. And either we could see an uptick in demand in the housing market, or we could see home buying conditions be a lot less favorable, which would be tough for you as a home buyer. So again, it's a little bit debatable, but I do think now is a good time to get into the market based on where we're at. And that's my thoughts. That's my thoughts on the CPI, on what the Fed might do or might not do. Let me know what you guys think. All my contact information is in the description. If you're looking to buy or sell a home, reach out to me directly. Otherwise, leave a comment. I love knowing what you folks think. And I'll see you guys in the next video.